I think that President Trump would like to get the share shift going again towards lower income tax rates and maybe higher tariffs. And maybe that's not a bad thing. I'm not a fan of any increased taxes, but it certainly did work well in the early days of our history. Here you can see, and this is updated for the latest real GDP growth and productivity numbers, we're around that 2.5% number for both right now. We'll get into this in a moment, but in the short term, given all of the uncertainties, we could see these dipping a bit until this administration has its programs in place.
Cathie Wood, the powerhouse investment manager and CEO of ARK Invest, has just revealed the truth behind Trump's economic strategy in a remarkable speech. She unveiled the key to Trump's game-changing approach: lower income taxes and higher tariff. And contrary to what the media may suggest, it's not the disaster many claim it to be. Historically, this strategy has worked wonders for the U.S. While Wood isn't in favor of higher taxes, she highlights that this bold move is already yielding tangible results, with GDP growth steady at 2 to 2.5%. Though she cautions a short-term dip due to current uncertainties, Wood insists it's all part of the genius plan. Once Trump's initiatives fully take effect, prepare for a booming economy. But Trump's strategy isn't just about the numbers, it's about fostering innovation and advancement. Wood emphasizes that the key to long-term economic success lies in pushing boundaries and sparking a technological revolution, something Trump clearly understands. So, what's next? Wood reveals that the Trump administration is paving the way for a bold economic future. Buckle up, this is just the beginning. Let's watch highlights from Cathie Wood's speech for a deeper dive. Before we continue with the rest of the video, do check out daily 5-minute crypto newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now.
This chart is giving this administration license to cut spending and streamline the government in as many ways as possible, especially regulations, to stir economic activity. So the way to get the deficit down, so to get this line moving up, there are a couple of ways, actually: cutting spending, which of course this administration is doing, raising taxes, which they do not want to do, except, interestingly, for perhaps private equity. We'll see if this time around the private equity tax breaks are eliminated. You know, philosophically, I don't really want tax rates to go up for almost anyone. I'm thinking, wouldn't it be nice to get the tax rates that private equity enjoys? So those are capital gains tax rates, 20%. Wouldn't it be nice to get those tax rates across the board in investing, including for companies like ours? We, of course, are subject to the maximum tax rate in terms of our own income. What about getting that closer to 20%? That would be consistent with a flat tax. So really paying a lot of attention to the direction taxes are going to go. And I think it's going to be very positive for the financial markets. The other way to get this deficit down is to grow the economy very rapidly, more rapidly than it has grown over time. And we think that is possible. I will get back to that when we get to our big ideas. We have a strong point of view about how much faster the economy could grow as this administration unleashes incentives for innovation and increased productivity, accelerated GDP growth. So we think the various programs are going to take this deficit certainly to where Treasury Secretary Bessent wants to get it, and that's 3%, minus 3% relative to GDP. But if this administration is successful in getting growth moving quickly as well, which we think it will be, we could get closer to that 0% mark. Now, here is the chart I was talking about. Tariffs versus income tax rates, both individual and corporate. At one point in our history, our early history, tariffs were the majority of government income. And you can see the switch in the early 1900s to income tax rates. I think the first income tax rate was 1%. And of course, now the maximum tax rate is, I think, more than 37% for individuals. I think that President Trump would like to get the share shift going again towards lower income tax rates and maybe higher tariffs. And maybe that's not a bad thing. I'm not a fan of any increased taxes, but it certainly did work well in the early days of our history. Here you can see, and this is updated for the latest real GDP growth and productivity numbers, we're around that 2.5% number for both right now. We'll get into this in a moment, but in the short term, given all of the uncertainties, we could see these dipping a bit until this administration has its programs in place. And the other reason it could dip a bit is because the velocity of money, I'll get into that in a moment, is already starting to slow. And so we'll touch on that in a moment. The dollar going up, combined with productivity gains, those are two powerful anti-inflationary forces, and we do believe they're going to work. So the market's fears about inflation reigniting, we think, are misplaced. The yield curve, this has been an interesting story over the last really more than 13 years. You can see that the yield curve, which is the difference between long-term and short-term interest rates, short-term usually are lower than long-term interest rates. But you can see the slope. We've been in a declining slope in terms of this yield curve for the past 13, 14 years. And we ended up in an inverted yield curve for a little more than a year's time. Inverted meant long rates were lower than short rates. That has flipped back around recently, and so we're going to be testing this downtrend. We could see a little more steepening. And we'll see if this downtrend has been broken. Why are we paying attention to this downtrend? I believe that the fixed income market has been sniffing out some deflationary undercurrents. And so long rates have not moved much above short-term rates because they are very much influenced by inflation.
Cathie Wood commented that the current administration's efforts to cut spending and simplify government regulations are aimed at stimulating economic activity and reducing the deficit. She mentioned that while the administration is already implementing budget cuts, it is not considering tax hikes, except possibly for private equity, where tax incentives could be removed. Wood expressed a preference for a flat tax, comparing it to the 20% capital gains tax rate as an ideal model. She also emphasized the importance of rapid economic growth, suggesting that the administration's initiatives are designed to foster innovation and productivity. Wood believes that this approach could significantly reduce the deficit, potentially bringing it down to 3% of GDP or lower. Let's return to the interview and watch more clips to hear more insights from Cathie Wood.
On to monetary policy, and here you can see money growth. I think we're up to 3.9% M2 growth on a year-over-year basis. You can see that in the purple line. The purple line tends to lead inflation. Now, you can see the purple line suggests that we could get down to 0% or less inflation generally. And you can see we're a bit stuck in the 2 to 3% range. We believe the reason it's going down now, or one of the reasons, is because a lot of new rental units are coming onto the market. There was a huge construction boom and it really started after 08, 09, as we were at 0% interest rates, and private equity money especially was looking for yield. And so a huge amount went into non-commercial, non-residential construction, so commercial construction, much of that in multifamily. And so we're beginning to see the early signs that that supply is coming into the market. And you can see it's a good leading indicator for the other much more lagged parts of the rental index. So those are owner's equivalent rent of residence. Both of these are in the CPI, and rent of primary residence. And so we think those numbers are going to come down from the 5-ish% range on a year-over-year basis down to 0 or even less, because the building over a decade period of time was quite substantial. And then the other reason we think inflation could continue coming down is velocity. So here you can see the velocity of money, which is the rate at which money turns over. It was part of the disinflationary movement in this century. The velocity of money was coming down. It was turning over at a slower and slower rate. So it was taking some of the firepower out of money growth. And you can see here, after the tech and telecom bust and that recession, we had a little bit of a lift in that cycle before it resumed its decline. And then in 08, 09, we had less of a cyclical bounce because it was such a bad period, and there was a lot of fear in the marketplace. So the velocity of money continued to slow. It plummeted during COVID, as you can see, and we have had a bounce back, a cyclical bounce back, bigger than the ones we've seen in this century thus far. But it is starting to roll over, and you can see this on this next chart, the velocity of money on a year-over-year basis. It peaked around 11%, so it was adding to the firepower of money. And it has been slowing. It's now at 1.3% as of the fourth quarter. But if you do the quarter-to-quarter sequentially, it has started to fall, which means this is starting to work against money growth in terms of stimulating the economy. Now, if money growth is only 3.9% on a year-over-year basis, and this and the velocity of money starts falling, or even just flattens out, goes down to 0 on a year-over-year basis, which we think it will. There is a lot of uncertainty, new administration, a lot of fear as to what is going to change. There's a lot of excitement, to be sure, as well. But when it comes to the pocketbook, you'll find people will hold close until there's a little more certainty. So if we go down to 0 here, then on a year-over-year basis, nominal GDP will be 3.9%. And with inflation around the 2.5% to 3% range, that will not leave a lot of room for real GDP growth on a year-over-year basis.
Cathie would analyze the current state of monetary policy, noting the 3.9% year-on-year increase in the M2 money supply, which often precedes inflation. She suggested that inflation could drop to 0% or lower, and that the Federal Reserve's goal of 2% inflation might only require 1 or 2 interest rate cuts this year, depending on whether inflation continues to decline. A key factor contributing to this decrease is slowing rent increases, which have been falling since the COVID-19 pandemic, and the increased supply of new rental units entering the market. Wood also pointed out that the velocity of money, which measures how quickly money circulates in the economy, has been dropping since the early 2000s and is now declining again. This reduction could help slow inflation by limiting the pace of money growth. Additionally, she discussed the impact of tariffs on consumer morale and inflation expectations, noting that concerns about rising costs and tariffs have driven up inflation expectations, potentially influencing future monetary policy. Lastly, Wood warned that if inflation doesn't fall, real GDP growth might slow, with the nominal GDP growth rate possibly dropping from around 5% to 3.9%. She emphasized that these economic factors, including the drop in money velocity and rising inflation expectations, will play a significant role in shaping the economic landscape in the coming year. What do you think will be the most significant factor influencing inflation and economic growth in the future? Drop your thoughts in the comments below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.